Welcome to the Hedgineer podcast with your host, Michael Watson.
Hedgineer.
Hey everyone, and welcome back to a new episode of the Hedgineer podcast. I'm your host, Michael Watson, where we talk about technology, data, AI within hedge funds, asset management, prop trading, and investment. Today we have a special episode. I'm pretty excited about it. It's with our newest engineering leader, focusing really deeply on portfolio analytics and risk, but also how research ties into that. Jhanvi Virani. She just joined us from Goldman, where she was an engineering lead on the marquee product, but spending her entire career within the technology side of asset management and investing. So it's been great to have you on the team for the last couple of weeks, and you've already made like a pretty awesome headway into like how we're thinking about technology data within investing. So welcome to the podcast.
Thank you for having me. I'm excited to be here.
Yeah, of course. So one of the things would be great if you could actually just start off with a quick introduction about yourself. I know that you joined us recently, like I think it's only been 2 weeks, right?
Yeah.
And like then kind of tie like what made you to decide to make that jump and join over to the Hedgineer team based off of like the career path that you had?
Yeah. So I joined Goldman straight out of college, and I worked specifically on the marquee division within Goldman, which is the digital storefront of their sales and trading platforms. So I worked specifically on building software for our institutional clients, specifically our equity investor clients, and building out a platform that allowed them to more resiliently and robustly analyze their portfolio risk over time, as well as then hook in and plug into all of the different services that Goldman Sachs offers, whether it's swap trading, as well as prime brokerage services, cap intros, things like that. So I was really spending all of my time working on building software for institutional clients, and I found that very interesting. So when I heard about Hedgineer and I heard about the problems that they were trying to solve, I didn't really need to be sold on the idea that this was a valuable company or a valuable business model, because I've spent so much of my time working on these exact problems. But what I was really blown away with when I met you and other members of the team was really just the talent density of the people working on the team, the fact that everyone is very dedicated to this exact mission, but also comes from a very diverse set of backgrounds. We have people from finance, we have people from tech, we have people from startups, we have people from graduate schools. So I thought that this company was very well equipped to solve these problems in a very unique way. And the conversations that we've been having over just the past 2-3 weeks are really a testament to that. So that's really what drove me here.
Awesome. And like, I guess I could kind of flip it backwards. And one of the things that we got so excited about when we started talking was a combination of like technical excellence, which I think is generally a prerequisite. But then on top of that, a passion and interest in like a domain knowledge within the industry, regardless of the technology, like being able to think very thoughtfully about risk and the way that you want to be able to look at it, not only point in time based off of sectors, rotations, factors, things that are more idiosyncratic to names, but also how you look at performance attribution over a longer time history and what that can tell a portfolio manager about things that are going on in their portfolio that they maybe didn't intend or they didn't realize because they're just so in the weeds, and how you can use data and technology to be able to better answer some of that in a more scalable way. And you were just so thoughtful on that, which I find is, at least in my career, a prerequisite of anyone that's really good on client-facing technology roles, is that there is a innate passion and interest for what we do that has nothing to do with technology. Like, you want to use technology as a means to an end, but you have to be interested in the domain. And that was just inherently there, but also like the merit element. Like, you had this great transcendence within your previous role where you were able to identify problems and move into like positions where you're leading and influencing what other people are doing, and being able to influence other people is one of the most important roles in leadership, regardless of title. And like, that was just very clear. So like, I'm just letting you know that. I guess this could be like a feedback session mid episode, but that's what we got so excited about when we had the idea of working together. And then when you joined, it's just been like going from 0 to 60 really quickly. So it's been awesome working with you so far.
Yeah.
So, but where does that come from? Like, why? What gets you excited or interested about the domain of investing, asset management? That's not just due to the technology side.
Yeah, so I am an engineer by trade. That's what I studied in school, and that's what I was hired to do. But the thing that really gets me out of bed is how to apply that technology background into solving a problem that's very tangible and fungible. And one of my favorite quotes, I don't know exactly who said it, but it was some economist, and he said, people never make decisions based off of numbers. They make decisions based off of stories. And that's what I think portfolio management really is. Like once you start speaking with the clients, understanding what their objective is, they just want to understand how they can allocate their capital in a way that maximizes their alpha while also minimizing their risk. And that can become a slew of numbers that lives in an Excel spreadsheet, and it has for many years. But with the advancement of technology and making it more and more easy to scale large amounts of data in very intuitive ways, I think that there's a gap in what exists and what can exist. And I think institutions like Goldman, as well as buy-side funds, are doing a very good job in either building that in-house for their needs or building it as a part of their sell-side services. But that doesn't really encapsulate the much larger problem of the fact that there's no business that is making this their entire business model, right? Like you're always competing with the resources of what other priorities live with whatever institution you're working at. So the idea that Hedgineer is just focused on solving this one problem means that we're better equipped to solve it much better. And we're also better equipped to make it more customizable as the funds change the stories that they're interested in telling.
I agree with that. You touched a little bit on the sell side versus buy side dynamic, and it's something that people are into the industry know relatively well. And it's actually quite common, especially on the technology side, for somebody to go from like a Goldman into a buy side. And that path is pretty well trodden. For example, like my previous boss, the CTO at Citadel, was also CTO at Goldman, and he was actually awesome, huge fan. That's oftentimes like the path that people take. I'm curious to see like what your thoughts are, because you took a slightly different path. I kind of see us kind of in this middle role. But what has your experience been like being on buy side versus sell side from an engineering perspective?
Yeah, so I've never actually worked on the buy side, but I know a lot of people that do. And I do agree that it is a very common path. From my perspective, I really just enjoyed working with clients. And I really enjoyed building software that scales across different investment horizons, different strategies, and also different fund sizes. So that's the thing that I love the most about my job. And for that reason, moving to the buy side personally didn't make sense. But when it comes to the way that we're solving these problems, I've noticed in the couple of weeks that I've been here and sitting in on client meetings and differentiating how I think about problems versus how you or maybe Gerard thinks about problems, in that you all think about the technical problems of a fund as very horizontal, where you're connecting everything from research to portfolio management to event tracking, corporate action monitoring, as well as price targets. From my perspective, we only really built solutions that centered around where the buy side and the sell side interact. So we're really building things that will maximize the interactivity between prime brokerage services or the sales and trading desks to facilitate swap trades and things like that. So when you think about portfolio analytics specifically, one of the most pivotal themes of how I think about portfolio analytics is hedging, because when we build a really robust hedger that plugs into a portfolio analytics system, we can then use that to increase basket sales on the sell side. Whereas on the buy side, one of the themes that are very important to you and the rest of the team that I hadn't really thought about before I got here was how we're tracking analyst price targets and how that interacts and how accurate that is when corporate actions and events happen in the market, and how that paints a picture on what analyst is most effective at trading at different times in a company's life cycle, right? Like that's not something that we were really thinking about at Goldman. And part of the reason is probably there wasn't a very strong monetization angle on that from the sell side. So the things that weigh more and less, I think, are very different between the two. And I think that bringing those two ideologies together is a really valuable proposition, because that means that we're thinking about things in a very holistic way.
Now, and in my experience, I think we have to be thinking about it in a holistic way.
Yeah.
Where a analyst estimate very quickly turns into an idea encapsulated by a story, especially in a discretionary environment, that then makes its way into the portfolio in a position. And that position has its own life cycle and a way to evaluate it, which is where then you would start looking at it from a risk and performance attribution perspective. But being able to trace back that investment in performance, not just to when the trade was put on, but what was the research and the process that was upstream in a pre-trade process that justified why that decision was made in the first place, is something that is very tightly coupled. They're not separate. They're not two different processes and companies making them. That's the same investment team. It might be a portfolio manager that's working with an analyst that's then constructing their research and putting on a trade. But from the PM's perspective, that is one cyclical process that needs to be interconnected and explainable in a single system, which is what we try to focus on. How does risk interplay with research, interplay with portfolio analytics? And then in some regards, go all the way down to how you communicate that product, that interweaving of these different components to an investor relations team so that they understand this is the entire suite of capabilities of the investment that I'm making. And yes, it does have its own unique research process, its own idiosyncrasies, but there are also these other components of running a business of a fund and being able to communicate that it's not just the research that it's excellent. It's not just portfolio analytics. It's the entire business, the entire operation, that when you do entrust a manager with your capital, that they are doing everything at an exceptional level and not just one or two different pieces, and being able to help our clients, our managers, paint that story to investor relations is not a primary focus. It's not the business model, but that's just one other area that if we can solve it right on that upfront research, risk, trading operations, it's really empowering for some of these additional groups within the fund.
Yeah. And that's one of the things that I've loved working on the most. It's not just working on something like portfolio analytics, but sitting in a room full of people having that conversation about, okay, how does this connect with CRM tools and the IR division? How does this connect with research and how we think about instruments versus companies, right? Like we're thinking about things so holistically, and we're also young enough that if we get to a place where we think that we made the wrong call, we'll redo it. And we can do that without necessarily losing a lot of time and losing a lot of speed. So, yeah, I've loved that element of what we're doing here.
Yeah, it's a blast because we were talking earlier. We were talking, I think, yesterday or 2 days ago about the relationship between an instrument and a company.
It's like an hour-long conversation.
I know, and sometimes they can go a little bit too long, but I think they're productive as long as they go to like, all right, what are we going to action out of this, and how are we going to like take this heady intellectual conversation and then go and do something. And for me, that's actually not always easy. Like it's oftentimes easy to describe a problem, identify, there is a problem right there that doesn't work well. It's then an additional step to then articulate a solution to that problem. And then there's an even bigger step to go and actually execute and solve that problem. And I think that that's every startup's challenge, where they can identify a problem, they can articulate it well, but then can they create a solution? Can they go and execute on it? Can they go and like take that problem and now make it something that you've solved that's a competitive advantage? And I spend a lot of time thinking about, are we doing that as efficiently as possible? Are we as nimble as we can be? And it's something that I think I'll always fall on the spectrum of, well, we probably could have been faster. How do we get faster at solving that in the future?
But I feel like if you ever get to a state where you're like, yes, this is the perfect speed, you're wrong about something. You know, like, I don't think that there's ever a perfect state of a startup. But I think that there is a way that you can hire people that you can rely on to make those decisions. And that's one of the things that's blown me away about the people that work at this company. It's not just, hey, here's a problem. It's, hey, here's a problem, and I think, and then they kind of propose their solution. And then that starts a conversation. I think one of the things that can be really emotionally and professionally draining is working in a place where everyone has problems, but nobody really pitches solutions. And this is just not one of those places, So it makes it a little bit easier to get through the whole flow of not only finding a problem, talking about the solution, and then actually having the momentum to continue to implement it, which is something that I think kills a lot of startups, not having that,
And also having great people like yourself and everyone else that's aware of that dynamic, that if we don't solve something, if we don't figure it out, there's no one coming to save us. And I think sometimes you have that when in a large organization that it doesn't work. We're still making money. We're still profitable. It's still going to be there. Somebody else more senior will come in and then dictate what we're going to do, and it's going to then be solved, and the company will figure it out.
Yeah, like worst case timelines get pushed back a quarter.
Exactly.
That's fine, in the world of a company that's more than 3,000 people,
But in our world, like there's no one's coming to save us. We have to be able to go and solve our own problems, and that is empowering. But it's also it's a lot of responsibility, especially on like senior leadership, like ourselves. So, what are you excited to work on? Like, what are the types of problems that you want to be solving at Hedgineer? Like, what's going through your mind? Even like right now, I'm curious. Like, what are you working on right now?
So right now, I'm working on a lot of the kind of the foundation of what portfolio analytics will be. So a lot of that is having conversations like the one we were talking about, where we talk about, okay, positions are on instruments. Now, how do we aggregate those and abstract those instruments away from companies? And then that's laying the groundwork for how portfolio analytics connects with research and connects with things like analyst coverage and things like that. So right now I'm working on a lot of thinking and a lot of implementing. We've got some really, really interesting clients that we're working with right now, and understanding the narrative of what they're trying to solve and what they're trying to get their teams to really think through when making investment decisions. That's kind of what I'm working on right now. I think when it comes to thinking about what I'm most excited about, I think it's really the idea of a business paradigm where we put clients in charge of figuring out how they want things to be built or what they want to be built. We obviously come in as experts in the space, and we can advise them on what does and doesn't make sense and what will and will not work in the long term. But understanding what is the most important to, let's say, a short horizon, long short fundamental equity fund versus an endowment fund, those are two very different paradigms. And being able to talk to both of them from a very ground level and figure out what they want to get built, and then build two completely different systems for each of them, is something that no other company is really doing right now, or at least no company is doing well enough that they've captured the market. So being able to apply the domain knowledge that I have, but then also weaving it with the stories and the interests of a particular fund strategy and needs, and then kind of encapsulating all of that into an intuitive user experience where the design can vary from one client to another, is, again, it's very challenging, it's very empowering, but it's also it's a lot of responsibility. So I think that's the thing that I'm the most excited about, and I'm excited to use this as an opportunity to maybe even learn more about this space in a way that I probably wouldn't have in my previous role.
Yeah, and one of the interesting challenges that presents, because we do have a very customer centric process for how we actually like engage with our clients. I think Kyle was talking about it on a previous episode, where there used to be more of a product centric engagement model, but we're very customer centric, where we focus on what is the unique, what makes you special, and how do we enhance that while also instilling best practices and all the other things that you just want to be really good at, but it's not your primary differentiator. And doing that at scale is what we also spend a ton of time on and thinking about, is that we want to allow, generally internally, we think about an 80-20 rule. 80% we think is very consistent across a customer base. And then there's 20% that is unique that we want to have customized. And making sure that if we want to build this and scale the company, that 80% is a really solid 80% foundation. So when we go and approach like a new fund and we onboard them into the platform, that a lot of that is just print and repeat. We're going to instill best practices for how you think about a security master, how you think about position master, how you think about the way that a event is tied to a company, that's tied to an instrument, that's tied to a position. And that event could be a quarterly earnings call, or that event could be a FDA drug trial, or that event could be some judicial ruling. or it could be a macroeconomic announcement, an FOMC rates decision. But it is a way that a lot of discretionary funds think about their business. And then also, like, what is the relationship between a person, a human being, whether they're on a management team or a chief research scientist or a decision maker that's associated to a company, that's associated to an instrument, that's associated to a position. And so what are the commonalities that exist that we want to get right within Hedgineer? And then what are the things that we want to allow to be customizable to be able to modify our platform for our clients? And getting that right is something I spend an inordinate amount of time on.
Yeah. If I could ask you a question, as someone that worked at one buy-side fund, how do you think about building out that 80% in a way that translates across the spectrum of investment strategies and investment funds? How do you think about what needs to be kind of consistent across everyone versus what needs to be customizable?
I think that getting the data model right at the core is where the least amount of customization happens, but then allowing customization on top of it via custom tagging. So an example of that is that having a single source of truth for a security master that has the same schematics across all of our clients, but the securities that are relevant for you as a fixed income private credit fund versus a long short equity fund versus a fund that's just trading options or exotics, those the instruments that you need loaded into that table might be very different. But generally speaking, the set of identifiers that you need are relatively well known: CEDAL, ISIN, RIC, IDBB Global, which is the same as Bloomberg's FIGI. And those instruments are oftentimes tied to a position. Now, there's different ways that you can think about trading data, where there's all of the intraday fills and orders that have been submitted, canceled, but oftentimes those flow into an end of day trade file that helps you net out what your exposure is across the different positions that you have. And just storing that accurately end of day historically is really empowering. It's sometimes easier said than done. But having that single source of truth for instruments, single source of truth for positions is a very strong commonality. Then, like, what you can do with that is you can take that and map that to a real-time position exposure feed from an order management system like a Flex or a Infusion, so that you could see, like, oh, what is our real-time gross exposure at an instrument level, and be able to slice and dice that with where did we start the day at, and historically join that up to where we are intraday. So now you have this like really good view of each one of the instruments at a granular level going back in time. But there's also other tags that you want on top of that. For example, ARC or Arcesium calls it like a bundle. Other funds call it like a PBG, PBR. Some use the term strategy or sub-strategy, but the way that you want to start grouping positions with position level tags so that you could then take a pair trade together potentially and look at how's this pair performed. You could look at a carve out of a sleeve of just one analyst's trades over time. You could look at a trade in conjunction with its hedge. So maybe you have a basket as well as a single long or short. Usually it's going to be a long, but be able to tag those at the position level so that you can then collapse those and see what your gross exposure was with the hedge and then individually without. So that's like position level tagging. We have a framework around that. And then just from that core concept, getting back to what you were asking, that is not something that is really unique to one fund or another. That is just what we've seen as best practices for how we think about data modeling from the instrument level to then the position level. And then how do we want to abstract out the research to take it from that instrument up to the type of research a discretionary manager might be doing, whether they're doing a price target, whether they're producing internal buy-sell signals. And then maybe the inputs of that could even be something from alternative data. So you're getting credit card transaction data, being able to aggregate that up, tag it appropriately so that you can forecast out a total revenue number for the upcoming fiscal quarter. So we do that by taking that instrument, at least in the equities world. There's other things that we'll do outside of equities. But in equities, taking an instrument and then mapping that to a canonical source of the issuer of that instrument. And then issuers oftentimes have different identifiers so that we can use an LEI, which is going to be a legal entity ID. And then that might also have a visible alpha ID so that then we can take the position that we have, map that to an instrument, map that up to a company, and then map that to something like a VA where we can then see like, oh, what are all of the forward-looking estimates? VA is going to be updating those in a regular day, aggregating across the sell side. But you could do like systematically for every one of our positions we have in the portfolio that is an asset class of equity. What's the price to earnings? So like, what's the expected earnings going to be for this name, and what is the actual price? And just have that be something that systematically updates and then alerts when there's a certain deviation based off of different ways that you want to cut the portfolio, but then also putting your own price targets on top of that. So like starting encapsulating your own research, being able to bring in like an alternative data set, let's say credit card transaction data, and like that might be forecasting out what total revenue might be by looking at a year over year or quarterly growth. And that produces its own expected future state earnings. And so now you could have that tied back in the whole model. And so figuring out that relationship between company and instrument is critical. And then you can start going off, that unlocks the whole world of research, at least in the equity space. But a lot of times when people focus on, I'm going to focus on our data strategy and our data, I want to hire a head of data science, or I'm going to hire a head of data. They really actually, on the buy side, just focus on that latter half where they say like, oh, I want to make sure we have great alternative data systems, or I want to have really good forecasting systems for our price targets. And then you ask them like, well, how does that tie into your sec master as well as your position master and your historical performance? And then, for example, how does that tie to risk? So the important thing in the risk side is you want to be able to tie each one of those instruments to a instrument ID that you might get from a third-party risk provider like a Axioma or a Barra or an internal risk provider, so that you can map what are that days in the equities world. Again, we're talking about equities. We do have half of our clients don't even touch equities, but some do. And if you want to be able to do a risk decomposition performance attribution from one of these risk models with a covariance matrix, loadings, and factor returns, well, you need to be able to map the instrument to the risk provider's instrument so that data can be joined together. So what I was saying earlier, when you have teams that are focusing on data, they oftentimes actually punt on all of that. That's actually somebody else's problem. Now, whose problem does that oftentimes bubble up to? Well, a lot of different people. Where we see is the COOs of these funds are realizing, wait a second, I'm responsible for these operations. I have a whole data team focusing on really good research systems, but like, what about my operations team? What about my risk team? What about my PM? Because the PM oftentimes they're the one that are just trying to figure out how we're going to make money within this environment, and they're doing whatever means necessary in order to get the data they need to be able to make well-informed decisions. So the COOs, once some of these funds are getting a little bit larger, I think they are seeing the breakdown in processes in these organizations that historically have been pretty siloed. And when they're trying to grow the fund, they realize that the risk team and the trading team, the operations team, the research team, and sometimes the alternative data team and the PM, they all are working on their own verticals. And they're like, all right, let's start getting economies of scale. They don't, underneath them, speak a common language when it comes to the data model and how all of this fits together. And because of that, just a lot of problems manifest themselves in a way that you can't always pinpoint exactly where it is, but oftentimes we'll then come in. We have these shorter term engagements where we start like with just 3 to 4 months. It doesn't need to be something that is a huge commitment. You're going to move all of your, so what we actually do is we have a bring your own cloud model where we work primarily with our clients' clouds. They just point us to your cloud, create us a subscription within that. We will deploy all of our software inside of that. We connect it to all of your systems. We provide you with great engineering resources to help you then do that 20% customization. And then let's get all of your teams using that as the operating system that you manage your fund on top of for risk, for research, for trading, for operations, for investor relations. And that just unlocks those synergies or those problems that previously were happening when these verticals were in isolation, and things just suddenly start working. So we start off by just making sure, like, that's oftentimes the common problem that our clients have, is that underlying data layer is what is the challenges they have, but it's also the commonality that we find within our clients, which was your original question of how do we find that scale as well as customization. And it comes back to where I started this monologue on the data model and making sure that we get that right. And then we can do customizations for how we want to build workflows or views or analytics on top of it.
Yeah.
So Jhanvi, I think that's a wrap. So I think it's been 3 weeks so far.
Yeah.
And I can't wait for it to turn into 3 months and then 3 years, and you to come back on the show and share some of the stuff that you've learned with the audience. And for the audience, thanks for tuning in. I'm your host, Michael Watson. This is the Hedgineer podcast, where we talk about technology, data, and AI within the hedge fund and investing world. You can follow us on Apple Podcasts, Spotify. Check us out on LinkedIn, as well as Twitter and Instagram. And until the next episode, have a good one.
Thank you for joining. See you soon.
Hedgineer.